Okay folks, welcome to this training on the gaps. So it's what you asked for. We did a poll last week in the live room and many of you decided that you wanted a little bit more training on the gaps. So here goes. This is actually a segment from our Trading the Gap for a Living course that we provide to some of our clients. I've been trading gaps for many years now. In fact, when I started trading index markets, that's really where I was focusing on. So I've got quite a lot of experience on choosing when to go for that trade or not. If you don't know what a gap is, then it's basically where the market closes. So for the FTSE, it closes at 4:30 each day, UK time, and it will open at 8 o'clock in the morning the next day. So the difference between where it opens compared to its previous day's close, we call it a gap. So you can either open up above the previous day's close, or you can open below the previous day's close. One thing you need to bear in mind is that you need to get the official close. So you can actually get this from a variety of sources. I've actually used Bloomberg here. I'll just pull it down. So you can just search Bloomberg and it will give you the official close each day. What you don't want to be doing is getting the official close from a broker chart, because the broker chart doesn't take into account the auction period. So what's the auction period? Well, once the FTSE closes at 4:30, there will be a flurry of buy orders and sell orders that come into the market just before it closes, and it takes a little bit of time for that to settle, for those buy and sell orders to come into the market. So it takes 5 minutes, we call it the auction period, and at the end of that you get the true close for the FTSE. Now you can trade the gaps for other markets. I mean, I choose to do it for the FTSE. It works particularly well for that market. But gap trading works on all indices, whether it's the German market, the DAX, or the American market, it's the Dow or the NASDAQ or the S&P, or even the Australian market, the ASX. The same formula works for all those markets. So we have two types of gaps. We've got the common closing gap, which, as I said, is linked to the previous day's close, and we've got the extreme gap as well. So that means that if we open above the previous day's highest price, that's an extreme gap up. If we open below the previous day's below the previous day's lowest price, that's an extreme gap down. I really like them because, as I said, they're linked to market function. They're linked to why markets exist in the first place, which is to match up buyers and sellers. So generally, you'll find that the market will go back and facilitate that function. I also like it because they're low risk. So these gaps generally complete on a daily basis. So you get in the morning, and they're generally completed by the end of the day. When I say generally completed, not all of them are going to win, so you'll either be stopped or you would have hit your target. I also like it because you've got a predefined entry, exit, and stop. So you're getting in just after the open, and you know where your target is, and with the system we use, you know exactly what stop you're using as well. So then the focus really is all on the system rather than you, and that takes a lot of pressure from a psychological point of view. It also means you can trade full-time. You can make full-time profits from trading part-time. So because the gap sets up at a set time each day, and it doesn't really take too long. Really, you just need to be there just before the open to open the trade, and then you can put your stop and target. So it really can take 5 minutes to 30 minutes each day to manage these trades, and provide a very nice income. They also have a really high win rate, so this keeps your confidence very high, which is pretty important in trading. If you can have systems where you can win really big, but if you're taking lots and lots of small losses consistently, that really does eat into your confidence. So it's pretty high. So we actually at Magnet Trading, we like to focus on systems where the win rate's pretty high, and that keeps our confidence pretty high. So there's also no picking tops and bottoms. So generally we find that a lot of our clients, or clients that come to join magnetic trading, they've lost a lot in the market because they're taking a view of where the market's going to go, and it's very easy to get sucked into when the market's really rallied to try and sell it, or you think it's very oversold and you try and buy it. A bit like what's just happened with the COVID-19 crash. You know, everyone was thinking, well, the market's really oversold, but of course it just kept going and going. So at least with gap trading, you don't get caught into those temptations, and eventually you'll end up blowing your account if you're trading with a view all the time. Regular opportunities as well. So gaps are created most days. I mean, we don't trade all of them, but generally there will be a gap that's there to trade when the market's open. They also work in bull and bear markets equally well, which is great because then you've got a recession-proof income. They're not overcomplicated. Gap trading by no means is rocket science. And actually we find that the more complicated a system is, the less chance you're going to make it effective for yourself. So certainly at magnetic trading, we're not looking for home runs here. We're looking for a nice steady income over a long period of time, and that's exactly what gap trading does. So you're probably thinking, well, let's go out there tomorrow and start trading these gaps then, Mark. If it gaps up, we're going to sell it, or if it gaps down, we're going to buy it. And likewise, if we get an extreme gap up, we'll sell it, and if we get the extreme gap, we'll buy it. Well, it's not quite as easy as that. Actually, if you traded all the closing gaps and all the extreme gaps with an end of day stop, i.e. you just come out at the end of the day no matter what the price is, it's actually a break-even strategy. So we do need to form a trading plan, and that really comes down to selection. So we must decide on what gaps we want to actually choose, and then we need to define our entry. So sometimes we'll get in right at the open, or we might be getting in at the end of the 5-minute period, but generally we're getting in within that 5-minute window. So we want to really pinpoint our entry, and sometimes we'll wait for the optimal price point in that 5-minute window. Also, stop criteria. We do use a predefined stop for the system, but there are many ways we can trade the gap using lower risk strategies. Again, really attached to that 5-minute window. And of course, exit parameters. Sometimes the trade doesn't make sense to stay in it, and you can come out of it a little bit quicker. All right, so that's a little intro to the gaps. Join us for part 2, where we're going a little bit more in depth for you.